Welcome to the System Simplified podcast, where we feature top leaders who share stories on how to successfully systemize a business. Now, let's get started with the show.
Hello, Adi Klevit here with the System Simplified podcast, where we interview top entrepreneurs, founders, and thought leaders about systematizing a business. And this podcast is being brought to you by Business Success Consulting Group. At Business Success Consulting Group, we create custom processes and tailor-made business systems so businesses can thrive and grow. And today's guest is Ryan Tansom. Hi, Ryan.
Hey, Adi, how are you today?
I'm doing great. How are you doing?
I'm very excited to be on the show. I'm not having you on my show. I'm obviously, you can tell what I'm used to.
Maybe one day I'll get to be on your show, but Right now you're on my show. So yes. And by the way, I'd like to give a big shout out to Jeremy Weiss, who introduced us. And because of that, you are on my show. So that's good.
Yes.
And Ryan, I'm really excited to have you because you are a true entrepreneur. You started your career working in your family business and you turn it around and end up selling it for an 8-figure. And then you decided you're going to start your current company, Arkona. Mm-hmm. And it's a great story about how you came up with that name.
I'm happy to tell it.
But you are helping other entrepreneurs grow their business, scale, be successful. And today we're going to talk about the 5 principles of growth. And we're going to concentrate on one of them. We're going to actually talk about how cash flow basically drive the growth of the business. And we're going to dive into all these processes and systems and de-risking the business. So it's going to be really exciting to talk about it. But before that, did I miss anything in terms of the bio? Do you want to say anything else about?
No, I'd say the only thing I'd add to it is that the podcast that I started that I did the flub on is we just hit our 300th episode. So More power to you. I love it. And I love the fact that you're bringing value to your listeners too.
Awesome. So what's the name how can the listeners find your podcast?
It's called Intentional Growth. So it's on all the major platforms as well.
Good. The intentional growth. Okay. So listeners, definitely go and put it on your favorite podcast so you can listen to Ryan. But now, Ryan, let's dive into the 5 principles of growth. So what are they?
So I'll even start for how they came, just as a little bit of a backstory. So after we sold the family business, there was a bit of a turnaround. And so you and I, when we were talking a little bit on the podcast prep, the business that we had was we sold copiers and managed IT services. And then we ended up having to turn that around. So a lot of systematizing that you talk about a lot, we ended up having to do that. And we were doing it out of sheer grit and will. And over the course of 6 years, turned around, sold the business. Learned just a heck of a lot, Ani. And that was in 2014. Then I spent like 5 years just kind of like flopping around trying to figure out who I was, what I wanted to do. And then realized that a lot of entrepreneurs don't know what the value of their company is. They don't know how to specifically grow the value of their company. A lot of people are focused on like top line revenue or just kind of some vanity metrics. And so I just had this huge passion for taking the complex and making it simple. And because I was always a bad student, that's kind of like my why. I was like, hey, like, how do I think about this? And that's what came up with these 5 principles. And the point of it was to have a framework of how to make decisions. So for example, if you woke up and said, I got out of the blue offer, if I need to, make a big investment into the company, how do we think about this? And what's going to move the needle to make sure that we're going in the right direction? So these 5 principles, and we call them the 5 intentional growth principles, and they go in order. And the first one, I'll just quickly give a brief overview of them, and then we can dive into the 4th. But the first one is your drivers. What do you want from the business and why? I know it sounds a little intangible, but truly so many people don't know who they are, what they want from their business and why. Legacy, make a big impact, family harmony, community, whatever it is, figure it out, put it to the top so that way you're using it as a decision-making lens. The second one is your financial targets. There's 3 of them. One is your target annual income. The second one is your target net worth. And the third one is the value of your business. So it's kind of like taking your personal financial plan and saying, okay, what's the value of this business net? And that's when we call it the actually, how much would you walk away if you sold the company? Leads us into the third principle, which is your exit options. There's 5 of them. We talk about ESOPs, private equity, internal transfers, search funds, and strategics. All of that leads you into this kind of shifting of the mindset to say, how can I grow a valuable asset and treat my company as an asset that's going to create choices for me down the road? Brings us to principle 4 of growing value. How do we increase the value of this business? Fourth, and the 5th principle is the team of advisors, making sure you're surrounding yourself with people that can help you optimize that plan to get there. So that's hopefully brings some context behind principle 4 of why we want to be diving into it.
Absolutely. I mean, I love it. You start with the why, with the purpose, which is very important, because if you don't know why you're doing what you're doing, how can you even move forward, right?
Exactly.
You have to also have specific targets. You know, you can, if you're shooting without having a target, you're just like shooting all over the place, right? So having those numbers and that definition is extremely important. Looking into the future in terms of your exit, right? This is a lot of, I mean, I see it with a lot of businesses. They don't have that plan. They don't know where they are going. So they can have targets, but then what, right? So love having that exit strategy. And then, of course, using that in order to actually build value out of your business. So you can have a business that has value. And of course, surrounding yourself with advisors that are there to help you. Once you understand your why, where you're going, how you're doing it, how to build value, you need to have the help that you need. So I love those.
Hand your advisors a plan that says, here's where I'm trying to go and why.
Right.
Honestly, the amount of entrepreneurs through the keynotes that I give, or the podcasts, or the work that we do, the amount of people that are just waking up and they're just like trying to drive revenue or margins. And that's about as the extent of it goes. Or, you know, the definition we have of a lifestyle business versus a valuable asset is this shift in the mindset where someone says so a lifestyle business, the way we define it is someone that's trying to pull as much cash out of the company as they possibly can every year. How much in salary, distributions, and perks can I pull out of this company to keep it alive? Difference is someone that's shifting their mindset that wants to grow a valuable asset says, what can I do to invest in this business to create a more valuable asset down the road? And that's where, as we've started to focus in on principle 4, and how do you systematize your business to create sustainable, predictable, transferable cash flow to create the valuable asset that you want. So you're focused on the right things instead of just how much money can I take out of the company this year?
Absolutely. And that also goes hand in hand with the future, right? Because if you want to define like your why, what's the future like? If you actually have an asset, then you can actually use it in order to create the future that you want.
It's 100%. And like so many people get so hung up on these words, exit planning. And I honestly, I've become very, almost a visceral reaction to them. I think that they're necessary words, but it's almost like estate planning, insurance planning, and retirement planning. People go, oh yeah, I'll do that when I retire. It's like, well, you should have been doing that for 40 years. And all same thing with estate planning, same thing with all the things that we know we have to do, but we hate. So when you the words kind of give this negative connotation versus saying, hey, if I'm an investor, I want to own this asset. And as an investor, I want it to be worth more money tomorrow. And then at the end of the quarter, tomorrow, and the end of the year, and then and next year. And so you're focused on, if I'm an investor, where am I going to put the capital into this business that's going to truly drive the value? And I believe that if people can see that, then they have a bigger desire to make those investments. But I remember back in our business, it's like, throw 300 grand in an ERP system. Why? Other than to, make people's jobs better. No. You're going to do that to create a more valuable company.
Right.
It's just a different narrative that I think gives people a bigger excited or a bigger why that's exciting to do the hard work. And then they can see the actual reward on the other side.
Absolutely. Absolutely. So let's dive into it. Let's talk about systems. Let's talk about how to increase the value of your business. So it's look at it as an asset, right? So what will be the first step that you look into or that you talk with your clients in terms of that step number 4 of building value?
So yeah, absolutely. Let's break this down. I want to set a concept out to tee us up, and then we can specifically dive into principle 4 about how to do that and how to actually create that valuable asset that everybody can control. This isn't just this isn't just hypothetical. There's an actual practical way everybody can do this. So to layer on this concept before we dive into principle 4 is, how do we talk about valuations? And you know that you've probably had people on the show, and there's so much jargon out there, fair market value and book value, and then equity value and enterprise value and all these different things. The reality is I love to have this lens that says, okay, here's two ways to think about valuations. One is the intrinsic financial value of the business. That is the value of your business as it stands today. That is based on the risk of the cash flow, period. It's like an investor. Right. So same thing with commercial real estate. What's the cap rate you're looking at? And you say, okay, what's the risk of this cash flow? Same thing with the business. It's the value of the business based on the risk of the cash flow. Compare that to what we call strategic transaction value. Buyer and a seller come to the table, two parties with lots of emotion, lots of human being messiness that have reasons behind the acquisition, that there could be a premium based on this, in the financial value, a premium placed on it because of strategic reasons for the nature of the purchase. There could be a discount if someone wanted to give it to their kids via an estate plan. Here's why I'm bringing that up is because until you sell the business, you won't know what that transaction strategic value is. And so people then put their head in their sand and like, I'll never know what my company's worth. And it's like total BS. It's like, no. Private equity is a huge industry. They buy companies and measure and monitor that value, and then they flip them for a profit. So while all of us as entrepreneurs who own our companies today, we should focus on the intrinsic financial value because it's what we can control and it's what is absolutely knowable as the base case scenario, no matter what. So what I love to preach is you can control that. And so if you focus on growing the value of your company by de-risking that cash flow, you can always do an ESOP, internal buyout, and an SBA loan will be able to fund off of it no matter what. You don't have to hope that some strategic buyer is going to come with a big bag of cash and write you a check for all your headaches and then have no options besides that.
Right.
Does that make sense? I just want to tee it up because then it gets us into, well, what creates value then? And so there are 8 functional areas of a business, regardless of what kind of industry it is. You could be a medical device sales rep or a medical device manufacturer. You could be a professional services firm. You could be a steel manufacturer. It doesn't matter. There are 8 functional areas, and essentially what these 8 areas do. And and this program came out of, it's called the Value Opportunity Profile. I don't care what system you use. It's really about just addressing how do I figure out the risk of that cash flow. So like whatever you're trying to do, we're trying to identify how sustainable, predictable, and transferable is your cash flow of your business.
Right.
And so there's this value opportunity profile where I'm at my business partner, where it talks about sales, marketing, strategic planning, finance, operations, leadership, legal, and I can't remember what the 8th one is. But anyways, all of these 8 functional areas. What's super fascinating is when you go through and you kind of talk about these 8 areas, I found out after taking this assessment that when I was in this training program that my dad and I, on 20 million in revenue, every time we had extra cash, we put it into the areas that we enjoyed and were good at, like which was sales and marketing. We didn't want to do finance. We didn't want to build out operations because it wasn't fun. And we're like, wait a second. Like, so if you came to me with a sales pitch for a new ERP system, we're like, wait a second. It's going to cost us an extra 300 grand, which because we were in lifestyle mode, which is 300 grand out of our pocket that year. And I'm going, well, for more headaches and more misery. Like that's quite the sales pitch, right? The poor software sales rep that was like trying to go uphill on that. But when we shifted our mindset and said, hey, all 8 of these areas have to be in balance to continue to scale. And what essentially, without getting into the technical math behind it, is this assessment is trying to figure out your company specific risk, because you could have 2 companies with a 10 million in revenue and $1 million in cash flow. One of them goes for double the value. Well, it's because they figured out how to make their cash flow more sustainable, predictable, and transferable.
So what made you change your mindset? What was the turning point?
When you can see that if you do A, B, or C and invest in your company, and the value of your company is going to go up by X amount, because your multiple might go from 5 to 5.5. Well, a 0.5 on $1 million EBITDA, and I don't know how technical we want to get here, but 0.5 on $1 million in cash flow that you're going to be multiplying, that's a lot of money. So you should be getting a multiplier effect on the investments that you're making in your company. So like so many times in us, we'd wake up and we go, I don't really want to do that. It's a lot of work. It's going to be a lot of pain. It's going to be a lot of headaches and challenges and political posturing and all these different things that are normal in business. When you can see what the return of that effort's going to be, I think people are willing to do that, but they kind of have to just make it up in their head and hope versus saying, hey, that there's an actual math equation that we can do here.
Absolutely. No, it's actually, I'm thinking about when people go and document, when business owners decide to document the processes and procedures and create playbooks, it's not always easy. And something exactly what you said, it's like the political, the headache, the this, the that, but it's an investment. If you have it actually well documented, you're increasing the value of your business. But it's not the fun part, right? So that can also, I understand what you're saying.
Well, and I think it can be fun if you have that mindset. And so let's be clear too.
That's exactly right.
It's not fun if you don't have that mindset. So I think it's all about the narrative that we're telling ourselves based on the goals that we're trying to accomplish. Like here would be something that someone would say after they come through our training. It's like, hey, I've got 1.1 million in EBITDA. Thought my company was worth $7 million. It's actually only worth $5 million. Pay taxes, pay some debt. And I'm like, holy crap, I'd only walk away with $2.5 million. If I sold my business that's doing 15 million in revenue, had it for 30 years, not enough, way out of left field that I was way out of left field. But now I want to take my EBITDA and go from 1.1 to 2 million and then invest in systems and processes and procedures to create a more valuable business. So this shift in mindset had that person focus on doing those investments. They're close to hitting it's about a $12 million valuation and netting $8 million and doing an ESOP instead, because they just shifted their mindset. And then they were excited to document and do all of their IT process and procedures. They went out and they got a quality of earnings. They went out and they were like handling their whole sales and marketing. They had like rep groups. So like in order to make that whole company as a cash flow machine more transferable, they had to say, what are we doing now? And how do we continue to make this easier for the next employee, as for the next buyer? They're just essentially, there's a lot of egos that need to be, put to the wayside to say, hey, the greater good is a more valuable business because it's better for everybody.
Yeah. Well, Ryan, we do it with our homes. I mean, when we want to sell a home, we find out what area of the home, if we're going to improve it, will give us the return on investment. And sometimes, if we go all out and we actually do a full renovation and we go, we attract a certain people that will buy our home, but we get it back the return, right? But throwing money in an area of the home that then is not going to give us the return, it's not worth doing. If that's what we want, we want to sell the business. I mean, the home, right?
That's like I live in Minnesota and it's like pools. You can put it in a $40,000 pool and it doesn't do anything for the value of your house, because we only have the ability.
Because if I was buying a house and it had a pool I will never use, I know what maintenance of pools are. I go like, I don't want to deal with it, right?
I honestly had a buddy that he had a pool and he actually had to buy $8,000 worth of dirt and fill it up to sell it. And like so many things in our business is the same way, because like you do things because you think they're awesome, but it's like if you actually took a step outside of yourself in the business and said, as an investment, what is this cash flow doing for me as the owner, not the manager, because you don't have to have a job in the company you own. So what is this cash flow doing for me? And what would I want it to be doing and reinvesting in order to sustain that cash flow and grow it over time? It's a completely different mindset. And all this stuff that you do, I think, is so important. It's the same thing with finance, like we do, right? Very few visionaries and entrepreneurs wake up and go, yes, can't wait to document my process and dive into the financial statements.
Right.
However, if they're using that as a guiding compass to create a valuable asset, I think it just completely changes the game and the mindset of what they're focused on a day-to-day basis.
It does. And as you said, it's kind of like it's changing the mindset, and it's the correct game for an owner, because an owner, if they act as an operator of the business, first, it will be hard to sell, right? Or to exit or to do whatever they want to do. Mm-hmm. But they're still working in the business. But it's also it's not the hat of the owner. The hat of the owner would be to grow the business, strategically figure out where they want to be, what they want to do, and how to do it, right? So when they actually understand that this is a game in terms of like, okay, so how do we invest in the business in order to make it an asset? And then we have an asset. I mean, that's really, then they're really working on the business and becoming an owner.
Well, it's super fascinating. I interviewed this woman, Trish Higgins, on my show, and she's around my age, and she's bought 31 companies in the last 6 years, her and her husband and her brother-in-law. And what they do is they literally go in and buy what she calls boring companies. So like landscaping businesses, plumbing businesses, like, random things like that. And what they do is they have this entire model that says, okay, what's the working capital needed in the business to accomplish the growth rate? And then everything above and beyond that, so essentially they have these 9 platform companies now, and then they roll up all the cash after the growth and after the working capital, roll it up to the corporate C Corp, and then they're buying new companies with that. She doesn't have a job in any of these companies. She has general managers. Every one of these companies, going back to what you do for a living, it's like they need to systematize all of this stuff to make sure that they don't have key man risk with other employee or their key employees. They got to make sure that they have, key man or woman risk could be all the way down to your payables and receivables process or HR process or whatever it is. If someone, especially in the labor crisis that we have right now, if you're not doing these things, it's just harder on yourself to continue focusing on the growth. It's just more of like fighting fires and making sure you're maintaining, which we all know if you maintain after a while, especially with inflation, you're not getting ahead.
Right. That's exactly right. Absolutely. So Ryan, tell us, let's go over specifics, how do we actually get the value of the business up by using systems and by driving through the cash flow?
So of the 8 functional areas, the recommend, again, like you've probably heard of John Warlow's value builder system. There's core value. There's a lot of these different systems that can help you understand your systems, process, and procedures. You and people can work with you to try and figure out, okay, what is currently going on? Some sort of measure of if you wanted to buy my business right now, how easy would it be? That's honestly, people don't need to overcomplicate this. If you wanted to buy my business right now, you would ask for everything, right? Comp plans and systems, processes, procedures on sales and marketing and finance and all, you would ask for everything. And usually people have none of it. So then all of a sudden they get an out of the blue offer, could be the out of the blue offer of a lifetime, and they decide not to take it because they freak out and they don't know what to do and they're not ready. So this is not about selling. It's about being prepped to sell. So I'd say start with, if someone wanted to come in today and people know by their stomach ache that they get, oh my God, this one area. It's of course it is, because it's what you go to sleep with a headache with. It's the same reason that headache is going to be a detriment to your value when you go to sell. So the first thing, we've had 350 people go through our training in the last couple of years. Universally, finance we see as the top issue, and this is why we actually built out our CFO services. But we'd say, okay, well, why don't you just shoot us your financials? We'll give you a couple pointers. We'd get tax returns. We get an income statement. It's this isn't useful at all. And so the first step is get your 3 financial statements tied together. And then you go into the cash flow statement. You say the line that says cash flow provided by operating activities. That is the number one line that every private equity firm, every institutional investor, and you as an owner that is looking on assets should be looking at, because the net cash provided by operating activities will tell you how well your business is doing. And that's either going up or it's going down. Everything below that line is what you choose to do with it, whether it's taking distributions or reinvesting in other things. So just go to that line and then say, okay, how sustainable, predictable, and transferable is it? Well, it's positive, negative, positive. Okay, so why? What's going on? And then you just start to try and figure out, what are the functions? What are the departments? Where are the issues that it's having that be the case?
Like That's a very good starting point. And then what? What do you do with that after you figure it out?
So these 8 functional areas, if there's like I said, coming up with some sort of an assessment. And again, we have landed on the VOP, the Value Opportunity Profile. I've interviewed Ken Sanjanara, the creator, a couple times on the show. And what that assessment's doing is showing you which of these functional areas are out of balance. So essentially, like if for my dad and I, we would have scored off the charts in sales and marketing, but then we would have had way less on finance and operations and people. because we actually really enjoyed sales marketing. So the goal is first to shore these up. So taking some sort of assessment, and we're not pushing an assessment on this because we don't even subscribe to his tool. We just know that some people need this. Is somehow you need to have an understanding of your weak areas. And so
I would say the health of the organization, right? I mean, you look across the boards on the health of the organization, but you have to have tools to measure it. And an assessment is definitely a great tool to do that.
Right. And that's why I'm kind of pushing down the importance of whatever assessment it is. Just do one is my point. Like, because this is not some go take the value builder system or go take core value or any of these. I don't really care. It's more of, okay, what are the areas and the functional areas in your business that are weak? And then you have to figure out how to get them in balance so that way one of them is not holding you back. We really like the VOP, and it's because Ken came from. He was a CFO in a public company. He says master's in tax, master's in finance, and is it Pratt or whoever it is that one of the founders of the business valuations was talking about how his specifically gets into this company specific risk. That's part of the multiple calculation. So it's actually,
you use it in your company. You use that assessment. You found it good and valuable.
Yeah, we like it. Yeah, it's a way to.
Which is great. I mean, it's good to share with our listeners, tools that work, right? So because it's just like going to a doctor. There is a symptom. There is something going on. You have to get to the root cause. The first thing, it will be a diagnostic, and you can have different types of diagnostic, but you really want to have one that has proven successful, so you can actually concentrate on the area that needs the most improvement. So,
and Ken's actually rolls up into the valuation too for that intrinsic valuation. So kind of going back to how would anybody actually get the baseline? Because in order to understand, I want to get to a $10 million valued company. Hopefully, you know what the net proceeds would be if you sold it at 10 million bucks. But the reality is you need to figure out where you are today. So our recommendations, I don't know what you've talked about with your listeners before, but get an indication of value, not some necessarily free software that's kind of, way arbitrary. It's more like, hey, indication of value from some investment banker or broker that says, hey, from the intrinsic financial value, here's roughly what you're looking at. And comparables, if you sold it to a strategic buyer, could be this. So you kind of have a delta of what's the difference between the two. Now you got a starting point. Now you say, okay, there's three things you can do to grow the value of your business: increase your EBITDA, increase your multiple, and pay down debt. If you do all three of those things at the same time, you can create an insane amount of wealth. And so all things being equal, if you kept your EBITDA at the same amount and you kept your debt at the same amount, if you kept your EBITDA at the same amount and you kept the revenue at the same amount and you just invested into areas that de-risk your company and maybe pay down a little bit of debt, you could literally just increase that multiple because, I totally messed that up. Let me backtrack for the listeners.
Sure.
If you had hypothetically $1 million in EBITDA and it stayed the same and you invested in the systems and processes like we're talking about, you could keep the EBITDA at the same amount and the company could be worth more money if you're putting them into these areas that we're talking about.
So let's give an example. Give an example of a company that you worked with, or even from your experience of your family business, on some specific investments that were made. You talked about the ERP system, so that is definitely a specific investment, right? You can maintain the EBITDA the same. You invest in the ERP, but hopefully it will increase it because it should increase revenue. But let's say even if it didn't, you can do things more efficiently, so your profit is actually higher.
When you can trust the data, let's just pull that apart, because even if you implemented the ERP system and it did not increase revenue and it did not increase EBITDA, if I went to come buy your company, you'd be able to show me the data that showed you the profitability per SKU. You'd be able to show me the inventory turns. You'd be able to show me when and how you had technicians call back and a contract profitability. You'd be able to prove the story that you're trying to tell. If you think about what you do and what we do, it's like, hey, systems and processes and documentation plus finances, all they do is help prove the story that the owner's trying to tell, which then makes it
story, and it creates the infrastructure that then, it proves the story, but it's also the infrastructure of making the business go, and operate, right? But as you were talking, I'm thinking, you're talking about basically providing the measurables, the statistics, right? The KPIs that show the story, that basically, because the numbers don't lie if you use true numbers. You can lie with numbers too, but if you have the true numbers, you can show that you invested or you did this and this and that in the business, that process or that system. And that should reflect in the production, that should reflect in the scorecard and the statistics. Well, we did that, and now it takes us the turnover time is much smaller, or the number of the top revenue divided by the number of employees is much higher because we need less employees, or the top revenue is higher, or whatever.
Employee utilization is better. All these things, and you can get to data in statistics, but that doesn't mean that for example, that the owner is going to do anything with it. So that's why when even though you might have it, it's future potential. So your company is worth more because it's more transferable, sustainable, and predictable. But if I saw that, just because you didn't take action on it, I can at least better understand what I would do with that company. I want to go back to, you asked about a case study to make this practical. So there's a company that we've worked with, home remodeling business, and they didn't have their financials. So they went through our training, and it's like, hey, we want to grow, and we're growing, especially the last couple of years, right? I think their backlog is insane, but they didn't have their financials in a way that said, how can we grow, and can we afford to grow, and where should we invest our time and money? And so what happens is, after going through the eight functional areas, it's like, well, we can't know where we're at all unless we start with the financials. So essentially, it's almost universal. Everybody's like, I got to look at my financials, tie my 3 financial statements together, building out your projection to say, where am I at? Where could I be going based on my ideas? Then you go, okay, well, how confident am I in those ideas? People go, meh. And by the way, this is to say that a lot of these companies that we work with are running EOS or traction. That's an operating system. So you have to know what you're going to put into the operating system for it to work correctly. So that's really, I want to distinguish. EOS is just execute like heck, but you need to make sure use the 8 functional areas and the value creation lens as a input into the EOS system. So they got their financials in order, looked at the projection, said, I'm not as convinced as I should be, as confident as I should be. Then the next step is build a strategic plan. So that's another one of the 8 functional areas. If you're not confident in your projections, figure out how to get more confident, get a good strategic plan put in place that's written down. You've thought about your product pricing fit. You've gone through a SWOT analysis. You've done the ANSYS matrix, whatever the exercises are that help you understand the trade-offs that you're going to have because of the restrictions of labor and capital. What are you going to put your money in that's going to move the needle the fastest on the strategic plan? Then those roll into the financials. Then you go, okay, now I've got projections out there, and I can see not only my income statement that's going forward, but I can see my cash flow and what's available via the cash flow, how I'm going to fund this. Then you go, how confident in my sales and marketing? People usually then go, So it's almost so interesting. Right. Where we see this order almost every time, because it's this certain degree of clarity then makes the next thing more clear of what needs to be worked on. So then sales and marketing, it's well, now we know what is profitable and what's not profitable based on the finances. We got a strategic plan that says we're going to go after this makeup of products and services in these areas for these prices. You can layer a comp plan that's actually accurate on top of that and say, okay, now for sales, here's going to be the comp plan so we can still hit the margins. And here's how this all works. Oh, by the way, now we want to layer on marketing to enhance the salespeople.
Right.
And then it starts to flow down and hey, how is all this documented? If someone else bought this company, are all of the things we just put into place documented so that way anybody gets hit by a bus, we can replace them. It's like a sports team, right? We now have a playbook. We now know where we're going. And we just want to make sure that as the thing's going, we're just increasing the odds that this is going to be around and growing at the end of the year and next year and the year after that.
I love that. Wow, what a great explanation, coming down to the importance of having everything documented, but it is definitely so true. You need the strategy, but even if you don't, you do the analysis, but then you need a strategy how to maintain what you have, right? Let's say if there are areas that are working well, how to overcome any obstacles or how to increase it, and then implement it for each area of the company. How is it actually going to happen? Basically taking the strategy, making it into a tactical plan and do it, but with the lens of increasing your investment, right? And increasing the value. So that is complete shift, and I think if our listeners today this is the only thing that they take. I think that's such a great takeaway in terms of shift the viewpoint of how you look at your business.
Mm-hmm.
If you want to. I mean, if you want it to be a lifestyle business and you want to basically milk it for cash every year and just continue doing that, that's fine. But if you want to have something bigger, something better, something that has value, definitely take a look at it as an asset that you're investing in order. And what is that return on investment?
I love what you just said there, and I want to unpack it just a little bit further.
Sure.
There's nothing wrong with milking it as much as you can. I'm going to give an example of this story. There was an executive recruiting firm that went through our training, a couple million in revenue, like, I don't know, like 8 or 9 employees or something like that, high paid executives at their place. And so they're making a bunch of money. And the worst thing anybody can do is not make a decision of whether you want to be a lifestyle business or have a valuable asset, which is what most people do. They go, I want to take all the money out and this thing should be worth $20 million at the end of the road, regardless. No, I mean, maybe on a hope and a prayer, but what I love is when people make an intentional decision and says, you know what? I don't want to spend the extra $500,000 and reinvest it every year. I do want to take that out. I'm going to invest in commercial real estate, put it into with my wealth manager, and I'm going to retire. And then whatever I get from this thing, that could be a couple year earnout, whatever, doesn't matter. Fine. It's a decision, and the expectations were in line with what they wanted. Versus, hey, if someone wants to create a valuable asset, fine. It's all about getting what you want. And so if someone wants to invest in their company to have a more valuable asset, my suggestion would be is hopefully you know that if you're investing in it, it's going to get that return.
Right.
Otherwise, if you're not going to get the return, take the money home.
Right. That's exactly right. And that's, Ryan, this is like have been the way that you look at it. I can totally see why it's intentional growth, because you look at a business and you're talking about a business in a whole different way that I've heard before, in terms of like, it's really intentional. It's what do you want to do? And if you want to do this, those are the steps, very specific steps. And that leads
so
to,
funny.
It's why.
Oh, it's just so funny because like and I didn't mean to interrupt you. It's like, like I would have been so shocked at how this is actually a thing. And I was like this too. My dad and I would just wake up, do more stuff. Hopefully we'll make more money at the end of the year. And like, I was doing this presentation the other day, this workshop in Vistage, very successful large companies. And this one woman looks at me and she just goes, after 3 hours of all this, she goes, so all you're saying is I have to figure out what I want and why? It's just like, I mean, how's anybody supposed to build you a plan if you have no idea what you're solving for?
Absolutely. Love this part of it. I'm part of it as well. So it's definitely a great group of people, a great group of businesses. And yes, but that's definitely a right realization. But that brings me to point number 5 of the advisors. Get the advisors. So you clearly can be a great advisor and are a great advisor for many businesses. And so if our listeners want to get a hold of you and find out more about it, how to intentionally grow their businesses, how can they do that?
Arkona.io, our website is a great place to start. And I'll make sure the listeners have access. We've got an intentional growth financial assessment. It's 22 questions on the financial, so we can actually show people what good looks like. So my partner and I walk through what a case study looks like on the results page and everything like that. And we've got videos on the 5 principles in the podcast. So it's all out there.
I will include everything in the show notes. So definitely check the show notes and make sure that you take that assessment, you watch the videos. And Ryan, this has been so valuable. So thank you so much for sharing all this wealth of information.
You bet.
And I hope our listeners will take it and really intentionally grow their businesses.
I love it. Thank you so much for having me.
Thanks for listening to the System Simplified podcast. We'll see you again next time, and be sure to click subscribe to get future episodes.